Welcome back to the third lesson. If you've been following along from the first and second video, we already talked about stocks, what they are, and then we also talked about whatever the second lesson was. I honestly forgot, but yeah. And today what we're gonna do is we're gonna build on more of like on the stock market, which I'm pretty sure is what we talked about the second lesson. We talked about why they're important and everything. We're gonna build on from that. We're going to talk about what our stock market index is, which is kind of like stocks, but it's a lot of them combined into one stock. You'll see. So yeah. So let's get this party started. So a stock market index is a group of selected stocks that are combined to represent a specific portion of the market. It tracks how those stocks perform together as a group. So it's kind of like an average score. You could take a bunch of stocks, sometimes 30, sometimes 500, sometimes even 1,000, and track their performance in a single number. So how they do this is they kind of combine all of these companies into one stock, and with this you're able to track performance. That number goes up and down depending on how the overall group of stock is doing, and that movement gives us a snapshot of how the market or part of the market is performing. So you could have an index of a lot of tech companies combined into one stock, and so if you could see that that index is going up, you could see that the tech market usually as a whole is improving and growing, or on the other hand, if it's decreasing, it's not as good. Not necessarily like growing, but you get the point. It's either up or down. So instead of following 500 individual stocks every day, we can look at one index number and get the general idea. So why do they exist? Indexes exist to make things easier. The stock market has thousands of companies trading every single day. Trying to track every one of them would be exhausting and honestly pointless. So instead, we use indexes to summarize sections of the market, like large companies, small companies, tech companies, or the overall economy. They help investors new outlets, analysts, and even governments measure market trends quickly and consistently. There are three major indexes. There is the S&P 500, the NASDAQ, and the Dow Jones Industrial Average. So these are the three. So you have the Dow Jones Industrial Average, which was founded in 1896. It tracks 30 U.S. stocks, and its sector is the blue chip. You have the S&P 500, which is founded in 1957. It stocks 500. It tracks 500 stocks, and it looks at 500 of the biggest companies in the U.S. And then you have the NASDAQ, which was founded in 1971. Tracks over 3,000 companies, and it's in the tech sector. So the first one, usually the biggest one, this is the one I day trade. It's my favorite stock, the S&P 500. So this is the big one. It stands for its Standard & Poor's 500, and it includes 500 of the largest publicly traded companies in the U.S. Some examples of it, you can see we have Apple, Microsoft, Amazon, Google, Johnson & Johnson, Coca-Cola. You can see the proportion of how much. So Apple represents 7.13% of the whole S&P 500. And then if you look right here, if you divide it by sectors, you got infotech, healthcare, financials, and all this. And if you add up all the companies here, it'd be 500. The S&P 500 is widely considered the most accurate representation of the U.S. stock market because it covers companies from every major industry, like I just said, tech, healthcare, finance, energy, consumer goods, and more. So when people say the market is up today, they usually refer to the S&P 500. So if you just search up the S&P 500, see how that stock performing. If it's up, it usually just means that the average market is up. The next stock we will look at is the Dow Jones Industrial Average, also called the Dow. This one's older and a bit more traditional. It tracks 30 large blue chip companies that are stable, established, and leaders in their industries. So in this case, we could think like Boeing, McDonald's, Goldman Sachs, Disney, Nike. Now, even though it only has 30 stocks, the Dow gets a lot of attention. But here's the thing, it's kind of outdated. It doesn't include some of the biggest companies like Amazon or Google, and it's price weighted, which is very significant. And this means that stocks with higher share prices affect the Dow more, even if they're not necessarily the most valuable companies. It's a useful indicator, but just know it's more of a legacy index than a complete market snapshot. Last but not least, we got the NASDAQ. I really like the NASDAQ. I don't know why, but Now this one is also interesting. It includes more than 3,000 companies, all listed on the NASDAQ exchange. The NASDAQ index is heavily weighted towards technology, so you'll see a lot of names like Tesla, Apple, Nvidia, Google, Meta, which is Facebook, and then AMD. Because of that, the NASDAQ is often viewed as a tech-focused index, and when the NASDAQ is booming, tech stocks are likely doing well. It's also more volatile, meaning it goes up and down more quickly, but that also means it can be a good indicator of investor confidence in the tech world. So, how indexes help investors. They understand the market fast. If you look at an index, we know if we're looking at an index that only tracks a certain group, so let's say the NASDAQ, you can understand how the market is working there. And if you're looking at the S&P 500, it helps kind of average out and see how the overall market is doing. You can compare performances. You can invest through index funds, and then an index fund is a type of mutual fund or exchange ETF, which we're going to talk about in a second. We're going to talk about ETFs. We're not going to talk about mutual funds. I'm going to make a video about mutual funds because it's a little more intense. We're going to talk about ETFs in this video though, with a portfolio constructed to match or track the components of a financial market index, and then you can spot trends and risks. So why indexes matter for you? So the first reason that indexes matter for you is a quick market snapshot. Indexes allow you instantly see how the market is doing. If the S&P 500 is up 2%, the overall market is probably having a good day. Instead of checking hundreds of individual stocks, you just check one number and you get the full story. Another point is benchmark for performance. Indexes also like report cards. Let's say your personal portfolio went up by 5% this year. This sounds good, right? But if the S&P 500 went up 10%, you actually underperformed, because even though your portfolio went up 5%, if you just invested in the S&P 500, you would have been up 10. Another reason is lower risk investing. Instead of trying to pick out individual stocks, which can be risky, you can invest in an index fund or an ETF, which we're going to talk about in a sec, that follows something like the S&P 500. One of the most famous ETFs is called the SPY, and it tracks the S&P 500. We're going to get into that in just a second. And so by doing this, you're instantly diversifying your portfolio, which means your money spread across hundreds of companies. So even if one or two companies do badly, it won't tank your whole investment. It's low cost, low maintenance, and super popular with long-term investors. Diversifying your portfolio is very, very important, especially across different industries. There's a chart which I don't have, but I know I could find it somewhere. But there's a chart. I'm going to pop it up on the screen now. But there's a chart that says as you increase the amount of stocks you have in your portfolio from different sectors, the better it is. And usually around having 30 stocks from different sectors, or not all from different sectors, but like from different sectors as well. That's pretty diverse. And as the more you add, the less risk it creates. But obviously, if you add like 10,000 stocks, it's not going to be much different than 7,000 stocks, because the risk significance decreases. Another point, and the last point, is market trends and confidence. Indexes also help you understand the economy. If the S&P 500 is climbing steadily, it usually means that the market is confident about growth. If all three major indexes are falling, that could signal a recession, fear, or negative news. Indexes don't just track stocks, they track sentiment. They tell you how investors are feeling. So investing in an index. So in this case, we're going to talk about an ETF. So another way to say what an index are, here's something even cooler. You can actually invest in them. You don't have to go out and buy 500 individual stocks to match the S&P 500. Instead, you can buy something called an index fund, or an ETF, which stands for exchange traded fund. An index fund is a bundle of stocks that's designed to mimic an index. So if you invest in a fund that tracks the S&P 500, you're essentially owning a tiny piece of all 500 companies in that index. The most popular example is called the SPY. I want to show you the chart in a second. Well, after I'm done the main lesson. That's an ETF that tracks the S&P 500. Another one is VOO. Same idea, slightly lower fees. If you want to track the NASDAQ, There's an ETF called QQQ. These are ticker symbols, by the way. That's not the actual call. These are just right here. These are ticker symbols. For the Dow, you have the DIA, and so on. These ETFs trade on the stock market just like regular stocks, and you can buy them through any trading platform. And if you're wondering what the best part is, they offer instant diversification. Instead of betting on one company, you're spreading your risk across hundreds of companies with just one purchase. This is why index investing is super popular for beginners and long-term investors. You don't need to be an expert. You just ride the market overall performance. It's simple also, it's low cost, like I said, and historically it's been one of the most effective ways to build long-term wealth. Lastly, we're going to talk about index reflection and motion. You probably heard people say the market is bullish, the market is bearish. So when the S&P 500 is rising consistently, we're just going to use this as a benchmark. It usually means investors feel optimistic, they're confident about the economy, company earnings, job growth, and overall market conditions. We call this a bull market, and you could think of it as a bull charging up. When indexes are falling, especially at once, like the S&P, Dow, and the NASDAQ are all dropping together, there's usually a sign of fear or uncertainty. Maybe there's bad news, a recession warning, inflation problems, maybe Trump wants to throw more tariffs, or even a global event spooking people. That's a bear market, and you could think of this as a bear swiping downward. Indexes give us a way to measure investor sentiment. They're not just cold numbers, they capture how people are feeling about the market in real time. That's why watching indexes can help you understand not just what's happening, but how the market is reacting emotionally. And if you can understand emotions in the market, you're already way ahead of most beginner investors, which is very, very important. Okay, so what I want to show you right now is I want to compare these two. So right here we have the S&P 500 index and the Apple stock we looked at before. It's kind of zoomed out, so I do apologize. But what I want to show you, the most important thing is right here we have all of this information, which we already explained what it is. But for the S&P 500, we only have this. You may wonder why. Some of them are self-explanatory, but I do want to just go over them again so you remember why. So the first thing I want to look at is the price earnings ratio and the earnings per share. So this, as you can see, we don't have it here. And the reason we don't have this is because the price to earnings and the earnings per share are specific to companies that report earnings and profits like Apple. But since the S&P 500 is simply just tracking a lot of different stocks, you can't really have price to earnings and earnings per share because it's a lot of different companies. Another thing you want to see is that there's no dividend yield. Like I said, first of all, some companies don't even pay out dividends. And if you have 500 companies in one stock, then it doesn't make sense. An index can't pay out dividends. An index is a lot of stocks combined. It's not just one company. So yeah, if another way I say it is, you could think of the SPX kind of like a thermometer. It tells you the temperature of the stock market, but it doesn't have its own numbers underneath. It's just summarizing the movement of 500 other companies. So it's kind of like averaging out in like an overall market. I think that's pretty important. So quickly recap, we talked about the definition of what an index is, why do they exist. We talked about the three indexes and kind of the differences and similarities between them. Well, they all the same similarity. They all track a bunch of different stocks. How they help investors we talked about. We talked a lot about why indexes matter for you. Investing in an index or an ETF. We talked about bullish and bearish market. And yeah. Okay, sorry. So another thing I do actually want to show you is these ETFs. So actually first, I kind of showed you the SPX, the S&P 500. But if we want to look at ETFs, you can see that this one tracks the S&P 500. They're also very, very similar in a sense. But what I do want to point out is we do know what this means. Previous close open, what it closed at, what it opened at, bid ask. We talked about that. There's the difference between this is a spread. We got the days range, week range, the volume, average volume. The reason the volume is much lower than the average volume is because today is Saturday. It's gonna be Sunday in a couple minutes, but today's Saturday, so obviously not many trades went through. But what I do want to show you, which I think is very important, I have it for this one, sorry, but I want to talk about this because this is kind of different, and you wouldn't find this on a regular stock. So first thing I want to mention is net assets. What is it? It is the total market value of all the assets held by the ETF. So this is how much in value it holds. And you might wonder, well, why does it matter? A high number like 1.33 trillion indicates strong investor confidence, its liquidity, and stability. It often means lower bid-ask spreads when trading. And as you could tell, the spread, if you just subtract these, it is very, very tight. It's less than 1. The NAV, which stands for net asset value, it is the per share value of the ETF's underlying assets minus the liability. There's gonna be another section more about assets and liabilities and accounting later. So for now, you're gonna have to search it up if you don't understand assets and liabilities. But yeah, and the reason it matters is because it helps determine if the ETF is trading at a premium or discount compared to its actual value. We're also going to talk about bonds, discounting, and all that in another section, but I think it's important to get through the stocks. These are honestly not that important if you want to get into the basics of the ETFs, but it's still good to learn. Once again, the price to earnings ratio of the ETFs holding. Now, ETFs do have price to earnings ratios because these are managed, but the S&P 500 just tracks the companies. So the S&P 500 basically kind of is a stock of all the companies combined, but then the ETF tracks it. That's why you can have a price to earnings ratio. And then we have the yield. The yield is very important. It is the income return or dividends paid out by the ETF as a percentage of its price. This is important for income-focused investors. Right here, 1.37% yield is moderate and typical for broad market ETFs. We can compare it to other ones to 0.63, 1.13, 1.65, 1.65. Did I open the same one twice? I think I did. Yeah, I did. Whoops. So we got 1.37. The YTD daily total return of 1.74. It is the ETF's total return, which is the equation of price change plus dividends. And this is so far this year. And the reason it matters is it gives a quick snapshot of performance over the current year. Beta, which is 5-year monthly, of 1, is a measure of volatility compared to the market. And then in this case, 1 means it moves in line with the market. This one is a little out of line. This one's a little above. This one's a little above. So this is a perfect one. It's beautiful. And last but not least, we have this expense ratio as a net. And is the annual fee charged by the ETF provider expressed as a percent. So we have this as percent. So this is just the fee charged by the ETF provider. And then the reason it obviously matters is a very low fee of 0.03%, which is very, very great for long-term investors because it minimizes cost drag and returns. So since you're investing it for a long time, you want a low fee. This is 0% fee, which is perfect. You have a 0.20% fee, which is not that long, but in the long run, if you're investing a lot, it will add up. You have a 0.16% as well. And yeah, that's pretty much it for today's lesson. When I talk about mutual funds in the future lessons, I'm going to go back to ETFs and explain them in a little more depth. Why they were created, how are they differ from mutual funds. And yeah, but I think this is a good start. You can probably now start looking into ETFs, do a bit of research and see if you want to buy any. And yeah, I think that's where we can wrap it off. Hopefully the video wasn't too long and you guys were able to focus. If you have any questions, you could always just email me or contact me. Go to the contact page and email. I would love to answer any questions. And yeah, thank you so much.